All right, good morning and welcome to Georgetown University, the McCourt School of Public Policy. My name is Kevin Lucier. I'm a research professor and co-director of the Center on Health Insurance Reforms chair. If you're not familiar with our center, we are a group of researchers that really focus on private health insurance regulation. We really care about access, affordability, adequacy of coverage. And we also publish research. We provide technical assistance to federal regulators, state regulators, policymakers at all levels. And we run events like this. So we're really pleased that all of you are here. We're very excited about this event. And it's the second event of a series of events called The Future of Employer-Sponsored Insurance. And it's focused on the future of a source of coverage that millions of Americans, including most people in here, rely on. It's the backbone of the US healthcare system, but it's under considerable strain. In this event series, we will continue to explore the sources of that strain and policy options that can help ensure that millions of Americans and their families can maintain access to affordable and high quality health coverage. Today, we're going to focus on the No Surprises Act. It was enacted in December of 2020 with bipartisan support, and it created new protections against surprise medical bills for 177 million Americans of all types of private coverage. Specifically, the NSA protects consumers from many of the most prevalent types of surprise bills by out-of-network providers and facilities in the emergency, air ambulance, and in-network hospital settings. After years of study and thoughtful debate, Congress carefully landed on a policy solution that protects consumers from balance billing and established a process to resolve payment disputes between providers and insurance companies called baseball arbitration. And it was meant to protect consumers in a way that contained costs. So today, we're going to hear whether those dual goals of protecting consumers from surprise medical bills in a way that constrain costs are actually being achieved. I particularly want to thank the sponsors of today's events, Arnold Ventures, for their commitment to improving the affordability and quality of health insurance coverage. There are few issues that are more difficult, and they have, as an organization, have taken this on straight on. I want to note a couple of quick logistics. First, the event is being recorded. We'll be posting a video of that recording at the end of the event, and so please share that with your colleagues that weren't able to make today's event. And second, there'll be an opportunity for all of you to ask questions. So we're hoping that you'll start to think of those questions, and at the end of the events, all you have to do is raise your hand and someone will come out and take your question. So we have today an incredible set of panelists. But before I have them meet all of you, I have the great honor of introducing this morning U.S. Congressman Bobby Scott. Congressman Scott has represented Virginia's 3rd congressional district in the U.S. House of Representatives since 1993. Congressman Scott serves as the ranking member of the Committee on Education and Workforce, his 5th term as the committee's Democratic leader, where he has worked tirelessly and often across the aisle to protect and expand access to affordable and high quality health coverage, including the passage of the NSA. Please join me in welcoming Congressman Bobby Scott.
Thank you, Kevin, for your very kind introduction. And I want to thank the Georgetown University Center on Health Insurance Reforms and Arnold Ventures for inviting me today and for everything that you do to help serve, help better understand and improve healthcare coverage for workers and their families. As you know, Congress took an historic step to protect our nation's patients against surprise billing when we passed the bipartisan No Surprises Act in 2020. But to understand the impact and implementation of the law, it's important to remember how we got here. Before No Surprises Act, surprise billing was a tremendous and devastating problem for millions of Americans. Far too many patients incurred unanticipated and astronomical medical expenses because, through no fault of their own, they received care outside of their plan's technical network, often in situations where they had no meaningful choice of provider. Now, since I'm at a law school, I feel free to express my frustration that what I learned in law school on the common law contracts when you seek services and didn't negotiate a fee, you have agreed to a reasonable fee. If you take your car to get an oil change and they come out and say, you owe us $1,500, you're not getting your car back until you pay up. They can't do that. That's unreasonable. Apparently, medical professionals are not subject to this normal common law, and they can make up any number they want and expect people to pay it. And that's what got us into this mess to begin with. Everyone here is familiar with tragic stories of patients who suffered severe accidents, were admitted to emergency rooms they did not choose, and were hit with surprise medical bills that they could not afford. Even those who were careful to avoid surprise billing medical bills, make sure everybody was in network, faced unanticipated costs because, for example, when they underwent surgery covered by their insurance, turned out that the anesthesiologist in the room was not in network and could make up a number and expected to be paid. In fact, studies from before the No Surprises Act found that roughly 1 in 5 emergency room inpatient hospital admissions and even 1 in 10 elective hospital admissions resulted in surprise bills. It's not just patients and their families who feel the consequences. These high out-of-pocket costs also burden employers who often share the cost of health insurance with their employees. In response, Democrats and Republicans, although we don't get together on much, did come together on this and included the No Surprises Act and the Consolidated Appropriations Act in 2021. Thanks to the law, patients are now protected against surprise bills in the vast majority of situations in which they previously occurred. The law ensures that patients pay only their in-network cost-sharing amounts for surprise medical bills, and it provides a process for insurers and providers to determine a payment rate for out-of-network bills, and hopefully that process will come back to the common law where they come up with a reasonable fee. However, while we can and should celebrate the significant progress we've made, there's still work to do. No Surprises Act does not address all situations in which patients may receive a surprise bill. For example, while the law already covers surprise medical expenses incurred in air ambulance services, it does not apply to ground ambulance services. Bipartisan provision offered by members of our committee, the Education and Workforce Committee, created a advisory committee on ground ambulance and patient billing, whose forthcoming report sometime later this year will inform future efforts to address this issue. Additionally, attacks in court have undermined the Biden administration's implementing regulations, contributing to the enormous backlog of disputes brought in substantial part by private equity-backed providers. Delays in payments caused by this backlog harm both providers and payers, while presenting enormous challenges to the viability of the independent dispute resolution process. But thankfully, while all that confusion is going on, the patient is out of the picture and is protected. Moreover, the Government Accountability Office last November found that years of underfunding has left the Department of Labor's Employee Benefits Security Administration, EBSA, without the staff and capacity it needs to oversee the enforcement of new laws, including the No Surprises Act. Yet despite this funding gap, some of my colleagues continue to call for cutting that agency's budget even further. And this is the last thing our employers, employees, workers, retirees, and their families need. We must provide the EBSA with the resources to fulfill their commitment to protecting workers and families' access to affordable health care. The obstacles that remain in the way of our work and eliminate surprise medical bills are precisely why today's discussions are so important. As lawmakers, researchers, and advocates, we have a shared responsibility to do everything we can to shield workers and families from unexpected, unaffordable, and unreasonable medical expenses. And so I thank you for all that you do, and please continue to protect our nation's patients and ensure that workers and their families have access to affordable, high-quality health care. Thank you. And before I leave, I want to introduce Stephanie, Carrie, Bertrand, and Daniel. Y'all stand up so people can see. We're on the staff of the committee. For the staff of the committee, doing healthcare work. So those are the ones you can get in touch with. Thank you so much.
Thank you, Congressman Scott. I'd like now to introduce you to Daria Plek, a principal analyst with the Congressional Budget Office, and to my colleague Jack Hoadley, who's a political scientist and a research professor here at Georgetown. Daria was part of the team at CBO that scored the NSA, and Jack has been researching and writing about balanced billing for the last, since 2005, right? The last 20 years. And you can read their full bios in your brochure. Daria is going to briefly describe provide some insight into the CBO scoring process for the NSA that determined that people could be protected from balance billing, but in a way that constrained costs. So we really appreciate Daria being here. And then Jack is going to get us up to speed on the latest research and data on whether the dual goals of consumer protections and cost containment are being achieved. Daria and Jack, I'll let you guys take it from here. Thank you.
I guess hit go. Right? If I can hit go. Awesome. Thank you guys so much for having me. I should stand near the microphone too. Where do I? No. Thank you. Yeah, thank you so much. I appreciate it. So thanks for having me, and I'm delighted to talk about how CBO thought about this law back in 2019, 2020. Next slide, please. So as Congressman Scott and Kevin said, the goal of this law was to protect patients by making sure that when they inadvertently received out-of-network care, they were only responsible for in-network cost sharing. And that's only one part of the law. That leaves unresolved another outcome, which is when that happens, what does the insurer pay the provider? And from the budgetary standpoint, that's what matters for us. So in the NSA, what they said was, we're going to establish an arbitration process when insurers and providers can't come to a resolution. And in that arbitration process, the arbiters should be looking first to what we call the qualifying payment amount, which is defined as the median in-network rate for what would be paid for that care. CBO's estimate was that arbitration process and that payment resolution would reduce prices, which would feed through to premiums, reducing the deficit by about $17 billion over the course of the 10-year budget. Next, please. But that was the final law. There were many iterations that got left on the cutting room floor. We gave about 150 unofficial scores between 2019 and 2020. And the outcomes of those scores ranged from deficit reductions of 20 billion to deficit increases of 50 billion. So that range is unusual. We can usually be more precise than that. And that range was driven by the fact that there were many different payment resolutions specified in the different laws. Next, please. So why do those payment resolutions matter? It is the view of CBO that in-network commercial prices in health insurance are driven by negotiation between insurers and providers. That negotiation takes into account a lot of things: insurer market power, provider reputation. But one of the things that really matters is what providers can get if they walk away from the negotiating table. Next, please. So what happens, like out-of-network care is a small percentage of care. Out-of-network prices are high, but that doesn't matter because it doesn't account for that much care. And so what matters is if the provider walks away from the table, they can get paid. And in turn, if the insurer can credibly threaten not to accept that amount and not have their patients get balance billed, that'll drive prices down. In the case of this particular payment resolution that was in the final law, we thought the median in-network amount was below average in-network amounts by about 15-20%, which drives in-network prices, which are the majority of care, down reducing the deficit. Next. So this is an illustrative bit of data. So this is commercial prices for knee replacements. There is no out-of-network payment standard for this particular service at that time. The x-axis is the Medicare commercial price relative to Medicare. And most knee replacements are paid between 1 to 2 times Medicare, but that tail goes up to 8 times Medicare. And what that does is that drags up the average relative to the median, and you get this big spread of prices. Next, please. Consider a different market. This is Medicare Advantage, and there is a payment standard for out-of-network care in this market. I know Medicare is different, but in Medicare Advantage, if you go out of network, you don't pay more than Medicare fee-for-service. And what we see is price compression, where the median and the average are driven down to Medicare fee-for-service, and you just have all of your care concentrated at that point. Next, please. So back to the law does a bunch of different things, but on the out-of-network side, it increases the amount the insurer has to pay for additional care they didn't cover. It increases what they have to pay for cost sharing. That's not most of the estimate. Most of the estimate is this 80% of reductions in in-network prices for care that isn't even touched by the law. Okay. So there were many alternative benchmarks considered. Benchmarks that are above the average tend to be deficit increasing. Benchmarks that are at the average are a knife edge case because, on the one hand, you put everything at the average, but on the other hand, like insurers have to pay a little more for administrative stuff, et cetera. We thought about laws where there was not an explicit benchmark, and we believed that those were inflationary based on evidence from the states. Arbiters have to consider some benchmark, and in the absence of explicit guidance, they may consider charges. Next. So in the interest of time, I will gloss over this. We thought about a lot of different things. The one I will emphasize is that arbitration relative to a stated explicit benchmark reduced savings by increasing uncertainty. We thought the arbitration process brought in additional uncertainty, and that was going to reduce savings by 20%. Next, please. This is just budget stuff. How do prices affect the federal budget? The short answer is through employer-sponsored tax exclusions. Next, please. I can talk about since 2021, but I am over time. Perhaps I should let Jack do that. Great. Thank you for having me. Next, to thank other people, including people in this room who helped work on the estimate. Thanks.
Okay, well, that's a good place to pick up. Next slide. So I'm not really going to say any more. We've talked about the goals, but I did want to note that, in addition to the cost saving goal and the consumer protection goal, there is the notion that fair payment needs to be established from both the provider and insurer perspective. So that's part of what this whole process of dealing with the payment mechanism. Right? So we did a qualitative study almost a year ago now, and we tried to look at the core question of, what's been the impact of this law, particularly on consumers, because the dispute resolution process was still very much in flux and still relatively new. We didn't mostly focus on it. We really focused on the consumer impact. And we found that, bottom line, consumers were being protected. We heard that convincingly and uniformly across all the different stakeholders we talked to. There seemed to be rare cases where balance bills, surprise bills were going out that didn't before. There certainly are some, but they seem to be rare. And part of the reason for that is both insurers and providers could tell us about specific things they did to make sure that happened. So they changed billing systems. The providers, put edits in their billing system to say, you don't send out a balance bill in these kinds of situations. The insurers changed their billing system for how cost sharing was going to be determined and what they're going to communicate back to the provider. So there really were explicit steps taken to make sure that this happened. In addition, the complaint system was up and running. That, now it's been more than that. It's really something that's going on. We've had some reports on the complaint process. But there is a way, if you have a problem with your particular bill, you can speak to federal folks. You can also speak to state folks. and you can get something done about it. We also noted, our stakeholders noted that there were still opportunities to expand protection, but really too early to tell about some of the broader impacts. The next slide. So as we've already talked about, there's been a lot of litigation out there, and there's been a series of lawsuits challenging various provisions of the law. Those have included some constitutional challenges against the core of the law. Those have mostly been shot down by the courts, but they're still, going through appeals processes. There have been challenges around the role of the QPA and other factors in the dispute resolution process. Their providers have prevailed to date, although again, still out under appeal. There have been challenges about methodology for calculating the QPA, process things, fees, batching of cases, and so forth. So we've seen this process as well with some lawsuits specifically against individual outcomes in the IDR. So litigation has been successful in some of these areas, but not in others, but a lot of it remains to be determined what the final outcome will be. Next slide, please. So most recent thing we've been able to look at is the data that have finally started to be released from the federal agencies about IDR outcomes. We've had reports for a while on the quantity of cases, but now we have information on the dollar magnitude. And so we published a brief on this just a week ago, but I wanted to hit a few highlights of that. So one of the things we're learning is that there's still lots of cases being filed for IDR. Arbitration is a popular process for providers, and you can see it in the graph there, it's gone up every quarter to date, and there's no sign of it slowing down. And that's far above the estimates of how many we expected. We also saw, especially early on, a lot of cases being challenged as ineligible. That's improved. The eligibility rate, the rate of cases being deemed ineligible has gone down considerably. And we also have federal proposed rule out that's going to promise to do some things to further clean up the process, hopefully deal with some of those ineligible cases in a more efficient way and so forth. So that's something to look ahead to. Next slide, please. The other thing that's really interesting to observe about this volume of cases is they're not happening uniformly. It's certain states, it's certain areas, it's certain specialties, it's certain provider groups that are filing cases. And so you see 4 states that are responsible for more than half the cases, all southern states. You see, comparing some of the larger MSAs, you've got places like Philadelphia, Los Angeles, and Washington, where almost no cases are being filed. And you have Houston, where there were 12,000 cases in a single 3-month period. It's also across provider organizations. We see 4 of the private equity-backed provider organizations are responsible for 2/3 of all the cases. We think that's significant, but it's still something we need to understand better is why is that happening? Why are some organizations using this route and a lot of others not using it at all? Next slide, please. The other thing we're learning from these cases, from these new data, is that first of all, more cases are being decided. So that's good. The system is working, things are going. We're also seeing there's still a large backlog of cases, and that's been partly because of the litigation that's caused various pauses in the process. But the information that's pretty new to us is to see how much providers are winning these cases. It's over 3/4 of the time providers are winning. And when they win, they're winning by a lot. Where a plan wins a case, they're basically paying out their QPA, their median in-network rate. So they're paying at the rate they would pay for network providers when they win these cases. And probably that's what they're paying in a lot of the cases that never go to arbitration, which is actually still the vast majority of all cases. But when providers win, they're winning at something like triple the QPA. So there's a real payoff to providers for challenging these. If they can win 80% of the time, and when they win, they get 3 times the rate they would have gotten if they lost or didn't challenge it at all, there's an incentive to go into arbitration. And that's the thing we need to understand more about. We always thought there would be a learning curve, but now we're beginning to have a chance to see what that is. Next slide. I'm not going to spend any time on this, but we talked about one of the gaps, and it was mentioned by the congressman, but we do now have a set of recommendations from this advisory committee. Their official report will be out probably in a month or 2. But we kind of know what they're looking at, and it's really to do the same kind of protecting of consumers, but not to use an arbitration process to do some kind of a strict payment standard. And so we'll be interesting to see what Congress does with these recommendations down the road. So next slide. Just to wrap up, the key issues that we're looking about here are that consumers are being protected, but the IDR process had kind of a rocky start, high case volume, litigation, backlogs, and success, and we've seen success by providers in winning. But we are seeing some change, and so our questions to look forward to are what's going to be the ultimate resolution of all the litigation and new rulemaking? Will CBO forecast for costs and premiums ultimately be met? And the longer term impacts on networks and provider consolidation and health costs more generally. And then whether Congress will actually do something with the ground ambulance issue. With that, I'll stop and we can turn to our panel.
Thank you, Jack. Thank you, Daria. That was great. Really helpful background. I'm now delighted to introduce today's what I call superstar panel, moderated by Julie Appleby, senior correspondent with KFF Health News. Our panelists are Katie Berg, Director of Federal Affairs, Leukemia and Lymphoma Society, Matt Fiedler, Senior Fellow at Brookings, Sean Grumminger, President and CEO of National Alliance on Healthcare Purchaser Coalitions. Their full bios are in your brochure, but I would just say all of these people have been working, covering, investigating, researching, trying to understand balance billing right from the get-go, offering policy solutions, and they didn't stop their work, after the NSA was passed. They've been engaged on implementation in a way that has been helpful, but they come to the table very knowledgeable, and I feel like we're very lucky to have them here with us today. Thank you so much. So I'll turn it over to you, Julie.
Thank you.
Yep.
Thank you for that nice introduction. We're going to have a conversation here. I'm going to ask a few questions and talk about the No Surprises Act, and then we're going to open it up to the audience as well. So at the end, there's going to be about 10 minutes or so. So please think of some questions because I really think to get some audience questions here as well. So with that, we're going to get started. Katie, what are you seeing so far from the patient perspective? Are patients now really out of the middle of these disputes, or are you still getting some calls? And what's going on?
Yeah, Julie, I think the good news, like the overwhelmingly good news for us, is that patients are being held out of the middle of this. I think one of the things that is abundantly apparent to any of the advocates in the patient space is that our phones used to ring off the hook with this issue. Our call centers were stocked with issues related to surprise billing. I think for people who represent chronic long-term conditions like the Leukemia and Lymphoma Society, this happened to them over and over and over again. And no matter how well they knew their health plan, no matter how hard they tried to avoid these issues, they couldn't get around them. So there wasn't like doing healthcare better for them. It was always something that was pernicious. It was always there. It created a lot of fear. It delayed a lot of care. It had a lot of negative outcomes, both financially and physically. And so we are thrilled. We're thrilled that this law is in place because our call centers are quiet now. There are certainly a few that fall through the cracks, but the overwhelming result of this law has been to protect patients, which is exactly what it was drafted to do. I think one of the things that we need to be cognizant of is that costs continue to be an issue for our patients without surprise bills. And so this issue is not just strictly related to, the financial harm that relates to a surprise bill where you're on the hook for lots of cash. But, this is a great step in the right direction. And I'm really excited to see that it's working so well.
Thanks. So Matt, so it sounds like the consumer is pulled out of the middle, but insurers and providers, if they can't come to an agreement on the bill, they have to try to work it out. Can you discuss what happens, kind of walk us through just a little bit about the process of if a provider and a payer can't work out an out-of-network payment, how does that play out?
So very briefly at that point, typically the provider has the option to trigger taking that dispute to IDR or arbitration. And, the basic mechanics of that process are just that each party makes an offer to the arbitrator. They get to make their case for that, why that's the appropriate payment amount for that service. And then the arbitrator chooses whichever one, they view as sort of representing the most appropriate price, and that becomes.
Are they supposed to rely on the median in-network price?
So, this is a hotly debated question, right? Frankly, my view is that the most natural reading of the law was that the QPA was supposed to be the sort of preeminent, this median and network price was supposed to be the preeminent consideration in arbitration. And then there's a list of sort of other considerations that arbitrators are also supposed to consider as sort of special circumstances where something, case is different than the norm. I think in practice, that's not really what's happening.
So what are we seeing about the results of these cases? Are these amounts even close to median in-network, or what are the amounts we're seeing?
Yeah, so we got our first real look at actual IDR outcomes, and Jack alluded to some of this in data CMS released a few weeks ago. And I think the nickel version is that providers are doing very well for themselves in arbitration. So, a colleague and I are going to publish something on this soon, but for services that go to IDR, and at this point, we're mostly talking about emergency medicine and radiology services as sort of the lion's share of the services that are going through. Typical decisions are in the ballpark of 400% of Medicare prices for those services. If you compare to what the sort of average was before the law, probably somewhere in the 200 to 300% of Medicare, depending on exactly what service we're talking about. And then the sort of median was expected to be meaningfully below that. And so, we're ending up far above where things expected to be. Now, it's early days, and the cases that are going to arbitration right now may not be representative of like a typical provider could get if they went to arbitration. But I think the evidence so far is that arbitration awards are going to end up well above.
So I have one more question for you. So Jack's slides pointed out that a lot of these cases are coming from like 4 states. CMS came out with a report saying about 3/4 of all disputes come from 10 initiating parties, including sort of large practice management companies, medical groups, or revenue cycle entities. What's your research showing? Who's bringing these? What's the most common type of group that's bringing these?
Yeah, and so I'm relying on the same data that you're citing, that Jack's relying on. So the basic picture is that overwhelmingly, that this has been disproportionately dominated by these larger practice or revenue cycle, larger practices or cycle management companies. And so they're the ones that are using this process at this point. And I think one of the big open questions going forward is their experience in this process idiosyncratic? Are they better at this process for some reason than the sort of smaller the other smaller practices, or are they sort of the canary in the coal mine, indicating that this is a really provider friendly process and it's going to be open season?
So Katie, this may be an unusual question. So with those higher rates, like if they're getting more than the median in-network amount, does the consumer end up paying any more, or are they just limited to what they would pay in network anyway? But if somebody's getting these larger awards, does then the consumer have to pay more out of pocket as a result?
Yeah, the overall cost is higher. Their percentage in copay is higher. So I think that's what we talk about in terms of costs. We know that cancer patients in particular struggle to afford their care. The first year cash total of treatment for patients newly diagnosed with leukemia is $500,000, and that's for their first year. And so the kind of cost sharing that's associated with treating one of these types of diseases, it's really high. And so while patients are being kept out of the middle of this, they're not getting a red bill in the mail anymore. Like that big, scary sticker shock number isn't happening in these like very discrete chunks anymore. They are happening in smaller over time chunks. And so if we see that QPA continue to be inflated over time, that does have both premium, we suspect, we don't know the data right now, but we suspect that it will lead to larger premiums. Sean, maybe you want to talk about this. Higher premiums, but also changing cost sharing structures. And so, I'm sorry, I don't want to get space here, but yeah, it matters. Like costs are really high for patients as it is. Even patients with insurance struggle to afford their care. And so it's really something that we need to be mindful of. It's like no longer like this big scary thing in front of you, but it's in a million different other places.
Yeah, so Sean, what are we seeing about the effects on employers and other payers?
So this morning, when I was getting ready, I tried to find my own black table. And I don't own one, so I wore this, but wearing all black, I think would help to signify how the experience is. So I've been working on surprise billing for a long time. Started at Families USA, went to the Purchaser Business Group on Health, consulting firm that works on surprise billing, and now here. The law has been fantastic. I'm glad that we still feel proud of it. It has been, I would say, an unmitigated disaster for employers. I would say it's too early to know whether it was completely unmitigated disaster, but the trends are bad and and I really do see a trend towards much higher inflationary factors. So just going back to the data presented by Daria, when you look back at what the estimates were, it was an estimate that we would have a relatively small number of cases that are going to arbitration. That number has gotten much higher than we expected, and it continues to grow from everything we can tell. And as pointed out, the payout for for providers that choose to go to arbitration is gigantic, right? So just if we think about this for just a moment, if I'm a private equity backed provider and I have the opportunity to say, okay, I could either accept the median in-network rate, QPA, which the rest of us would just call the market rate. Right? Like this is, if we just went through a negotiation, we hit a market, this is how much this is what we should be paying. I could either accept that, or I can pay a small amount of money, relatively speaking, to go to arbitration. And if I win, and by the way, I have a 75% chance of winning based on the data so far, I can get 3 times that number. What would you do? If you were a private equity backed company, you'd say, do I accept this? There's no loss to me. I'm getting paid what I would have gotten paid anyway. Do I take the small chance of losing and still get paid what I would have gotten paid? Or do I take the 75% chance and get 300% of what I would have gotten? I'm going to do that. I'm going to do that every single time. I think that's exactly why we're seeing, Jack pointed out, it's not just that we're seeing more people going to arbitration. We're seeing it concentrated in specific areas, and particularly large private companies, which we're very happy to surprise Bill in the first place. That's why we passed this. The worry is what happens next. As Daria identified, one of the few cost containment tools that employers and purchasers have in the commercial market is potentially the ability to say, I don't like that price. I'm taking you out of it. Right? Come back when you can be more reasonable. Now, because of the NSA, we actually don't have that ability. Right? We can take them out of network, but then now we're back in the NSA world, and they can get 300 times or 300%. So we've lost that little bit of leverage. I think the NSA is still great for consumers. I'm glad we passed it, but it needs significant work. And my concern is that increasingly it's not just going to be we're paying a lot more for out-of-network care, but now these private equity-backed companies have a pretty big stick to be able to say, I don't want 100%. I don't want the QPA. I want 150% to stay in network. And if you're an employer, what's your choice? I take you out of network and I just keep dealing with all these arbitrations and keep losing, or I go ahead and start raising your network rate, which then of course, yeah, it's not good.
Sounds like so some of the emergency physicians and the radiologists, among others, have argued that the fact that they're winning these higher amounts in the IDR show that insurers are offering too little during the negotiations and that the amounts should be higher. Do the providers have a point there at all?
No. I don't think they do. I will just speak slightly more on that. So I will, there are markets where you have a dominant insurer and providers that are a little bit, and we know actually, data from Family Foundation and elsewhere, that in those places, prices do tend to be marginal. Other areas where you have a more dominant insurance. However, the difference, like if you stipulate that the QPA, the median and network rate, the market is too low, we can have a negotiation. I would be willing to accept that in some cases the market price is maybe lower, not certainly lower than what providers would want, but maybe it's lower than what it otherwise should because insurers have space. It's not 1/3, however, right? Maybe it's 20%, maybe it's 10%, but it's somewhere in that range. It's certainly not 1/3 of what providers do, right? So when they say we need more money, we think the QPA is too low, great, let's have a conversation about whether we can increase the QPA or whether out-of-network arbitration price should be at 120% or 130%. But when they're getting 300% and then playing regular negotiations, they're just straight up lying. And I think we need to be able to call them out and say, like, you're profiteering, right? You're profiteering.
So a couple of private equity firms have gone out of business and have partly blamed the NSA for that. Matt or Sean, I mean, one of you want to say what might be going on there?
So,
line.
so I think there's some few theories you could have here. I think one of them may be that, frankly, where CMS came out of the gate and how they were going to implement the law, I think they came out with an approach through the regulatory process that I think would have resulted in outcomes, pretty close to what CBO was expecting, where this would have been a cost-saving law. And I do wonder whether that had influences in the early period on what in-network contracts were looking like. That sort of did mean that some of those groups couldn't secure the high prices both in and out of network that they were able to secure prior to the law. I think frankly, the fact that providers are winning as much as they are right now, I think indicates to me that both providers and insurers have been a little surprised about just how friendly IDR has ended up being to some of these groups. Because if they were sort of correctly calibrated, you'd expect a sort of a 50-50 win rate. And it turns out that, I think this has been a much more provider-friendly process.
Did you want to add something?
Just very quickly. So for folks who didn't live through the saga of legislation, regulation, you were there with me. Many of us in this room were. Very quickly, the original, and actually, Daria talked about this, 150 different potential estimates. The legislation shifted significantly over time. At the beginning, there was many of us pushed very hard to say, let's just pay the median and network rate, right? Common law, I think, Congressman Scott sort of identified, that argument. We ended up losing on that. But what we ended up with was this baseball style. Okay, so that was kind of a loss. I mean, not great. The legislation was okay, not perfect. We went to the administration, and credit to the Biden administration. They worked really hard, and they developed an IDR process that would have centrally kind of located the key and saying arbitrators have to consider this first. And as basically the preeminent consideration, how much is the market? And then arbitrators are allowed to, and encouraged to, and required to consider other factors, right? Which is it cost for you to lease the building? Are your providers particularly high quality? All of these other sorts of things. Totally reasonable. Start with the median, and then decide, does it make sense to go a little bit higher? The Texas Medical Association and others sued and basically said, no, that's not fair. You're not allowing it to profiteer. And they won, right? And they have consistently sort of, it's in litigation. I'm hopeful, I'm not that hopeful, but I'm a little bit hopeful that maybe we'll get some of that. So now what we have is a situation in which the arbitrator can consider anything, is encouraged to consider anything. And so you have, I think, frankly, IDR entities that aren't healthcare policy health experts. They aren't worried about the overall impact of the entire system, what it means for employers and consumers. And so they are, I think, wish I had a better way to say this, but they're sort of being duped into accepting, a price that's 3 times higher. Insurers are coming in with a pretty reasonable offer, right? Here's what we would pay if this was in network. We'll pay that. And somehow they're managing to convince the arbitrators that no, in fact, we need 3 times that. So I think the reason that we saw, I think, a lot of people building on is that early on, I think there was an assumption that maybe this would end up in the arbitration process. Some private equity business companies went out of business. Fantastic. Really pleased about that. But I think basically if they had just sort of held out longer and realized that they could actually be as successful in arbitrations as the people who stuck it out have been, I think they would have stuck around.
Yeah, Julie, I just to pile on the private equity point, if I may, I think as a patient advocate, I think we need to be really wary of the extractive practices that are intrinsic to the business model and applying it to healthcare and what that means for patients. There are very few, if any, studies that I'm aware of that say private equity is making patients feel better, faster, cheaper, all the things that they say that they're doing. And so when we have business models built off of things like balanced billing patients who are already in financial straits by virtue of maybe they can't work anymore, I think we need to take a really serious look at our healthcare system. Access is critical for patients, but private equity investment is not driving the kind of investments and benefits for patients. It's driving benefits for pocketbooks that aren't theirs.
So that's a great segue. We're going to spend the rest of the panel discussing. So what changes do you think are needed? Are there things Congress can or should do? What role do regulations play? What needs to be done to address your concerns? Sean, why don't we start with you? Because, you know, you call this an unmitigated disaster from the point of view of employers. So what needs to happen now?
I would say we're on a, yeah, revising civic marks. We're on the path to not making it a disaster. It could get better. Things could improve. I hope that's the case. But the path we're on is. It's interesting. So there's a strategic question that I've had with folks up here, folks in the audience, about whether we ask Congress to. And a lot of folks have said absolutely not. We didn't lose. We got a sort of a C bill, and some of our best champions who are on our side are now no longer in Congress. You know, if we reopen it, it could be even worse. Which I kind of asked the question: how could it be all that much worse? At least from a cost containment standpoint. Maybe it could. Maybe we could just stipulate you automatically get 4 times in market rate if you're out there. And I don't know that we would necessarily go backward in terms of this pretty strong bipartisan like every. So I think there is a real question of whether it is we actually do need to say Congress. You know, we have 3 levels, right? Policy. Congress can do it, the administration can do it, or the courts. 3 branches of government. That's kind of how we work these days. If we don't ask Congress to do it, we can ask the administration. Well, the administration tried. They produced a really good reg, and it got overturned. So I'm not sure. We have some administration folks up here. I'm not sure that we can go back and be like, "Hey, Biden administration, we think you're great. Double down, try again." Because they're gonna be like, "And I'll get sued again, and I'll lose." Right. So basically, it's now down to a question of: do we think we can make a better case in the courts, or do we think we can make a better case for Congress? I'm not convinced. So that sort of leaves us with this. I'm not saying, "Hey guys, let's all write a bill together," but you know, we are going to be, I think, potentially expanding the No Surprises Act or passing sort of sidebar for ground ambulances, which is absolutely necessary. Is that an opportunity? Maybe. Is it going to happen in 2024? Absolutely not. But I think we have to start opening our eyes to the idea that sitting and sort of waiting for this process to continue to play out probably.
So Matt, what do you think? Other things that need to happen as well?
So, I mean, I think, I tend to agree that I think the path to much better outcomes administratively is not but the sort of foreclosed that option. And so I think the question then for me does become, you know, if you were to go back to Congress, and I think the reality is that, like, during the debate, there were much better approaches. There were approaches that would have just like set a benchmark based on, you know, prior in-network payment rates, or ideally, if I had my drug received in a percentage of Medicare, but that was never popular during the debate. But, you know, there were proposals in that vein. They were advanced out of key committees. And I think policymakers should be, you know, just thinking about dusting those off, not under any illusions, frankly, that that's going to happen anytime soon. But I think it's what we should be doing if the goal is to reduce costs.
So Katie, can you talk a little bit more about what's going on with ground ambulance coverage? And also, there's also something in the law that says we're supposed to be able to get an advanced cost estimate when we have to go have some kind of elective thing. What's the status of that?
Yeah, so let me start first with the ground ambulance work, which Jack has alluded to and others too. And a big thank you to Tisha Kelmar, who serves on that committee. Thank you so much for your advocacy there, as well as your colleague Lauren, who also sits on that. So ground ambulances are a big problem for patients. Surprise. You know, you can go not very far and be hit with a huge bill that has been historically the status quo in our country. And we were really excited to see that air ambulance was included in the NSA. But due to a myriad of reasons, ground ambulances were not. So the advisory committee is getting ready to make its recommendations, but this continues to be a massive gap in patient care. And so we're excited to see what they have in store for us, and really look forward to kind of digging in, certainly with Congressman Scott's committee on a bipartisan basis, but everywhere else that will express any interest, because that is the one remaining area where patients are left completely exposed. I think the other thing, remind me the second question.
The advanced cost estimate.
Yeah, the advanced cost estimate is great, right? Like in terms of particularly for patients who are self-pay, I think that's really helpful. I think what is really critical for us as we kind of talk about this particular piece of the legislation is that it offers no protection. It is not a guarantee, especially for patients who are self-pay. So I think one of the things that we need to be, it is a vast improvements in terms of transparency for patients that they can see and get an estimate. I think the process for that is going to be very complicated. I think making sure patients know that they have the rights to request those types of documents is going to be very difficult to communicate, because I don't know about you, but healthcare's super fun. When you think about like your own insurance, right? Like it's hard. These things are complicated. And so making sure that like that kind of penetration into like patients like stuff is good. It's going to be hard. This is a good tool. It is not a magic wand.
Great. I'd like to open to questions. There's a lot of folks here who may have questions. So is there a microphone that we're using, or should people just? There's a microphone. Okay. Excellent. We've got a question right here.
Hi, fantastic panel. This may be a question more for Daria, but Matt, you had said that a natural reading of the statute is that the QPA should be front and center in the arbitration. And I'm just curious, if Congress were to say pass a bill that says, no, we really meant that QPA should be front and center, would CBO score savings from that?
That may be a question for Daria, but I mean, I won't. So let me put it this way. I'll say what I would say if I were sitting at CBO, and Daria can correct me, is, I think we seem to be on a trajectory where actual arbitration rewards are going to be substantially above the QPA, and that the out-of-network option is therefore, substantially better than a QPA-centric arbitration process would have been. And so therefore, there probably would be meaningful savings certainly from going to a system where you had a sort of QPA benchmark. And I think an arbitration process where the QPA really is central to the process would be almost as good.
Question right here. The microphone coming. Okay.
Sarah Hansard with Bloomberg Law. Sean, are you seeing any, or is anybody seeing any evidence that the QPA is going up, perhaps as a result of what's happening?
I don't have any evidence to point to yet. To ask other experts have sort of seen, but in networks. I will say this is one it takes some time, right? Because generally speaking, employers and plans are setting at least year-long, often multi-year contracts. So when you look at kind of the specialties that are most likely to engage in, I guess we can't even call it surprise billing now. We can call it intentional out-of-network billing. Emergency physicians, pathologists, area ambulance. Those contracts, have lasted a couple of years, and they're being renegotiated. And I think it'll be in the next couple of years. It'll be probably now, but it takes a couple of years for this data to be available. That we'll actually start getting a sense of, are they able to drive a much harder market because of their ability to say, happy to go out of network, happy to take you to arbitration, happy to get free. So unfortunately, I don't have the data right now, and I think it'll take a couple of years before we have a sense. Anecdotally, I think we can start getting.
Just to clarify one thing, QPA itself is frozen in time in 2019 and just goes.
Yes,
so that's not going to change based on the arbitration outcomes. But what could change is what in-network rates are negotiating forward, and that's what Sean's talking about. I think his point, we don't have great data on that yet, but I think the concern, certainly on my part, looking at where the IDR is then, is that we're headed towards a world with much higher in-network rates.
We have a question right here.
Hi, Josh Goldberg, Healthcare Service Corporation. So I appreciate the sunny beginning to the day, but maybe to try and suggest and move things in maybe a little more optimistic direction. Is there any low-hanging fruit in the implementation process where you think there might be broad buy-in from stakeholders across the spectrum in ways that might not dramatically, but meaningfully improve the process?
I mean, I'm looking forward to the regulation that CMS is putting out. I think that will help kind of square up all of the processes. The portal is now working. Like, just needs, it's like any laws are right. And so I think the efforts that CMS has been undertaking to kind of really firm up the expectations from both issuers and providers in the process is something to look forward to. I think that's what we've been hearing from payers and providers uniformly, but I don't know. if Stephanie thoughts about that.
The one thing I'd say is, I think that's right. I think there are opportunities to make the mechanics of this process work better, and that has potential. We've been talking about a lot about the ultimate payment rates, but another dimension of arbitration is it generates a lot of administrative costs, and hopefully there's more scope to keep those administrative costs under control. I will say that when you've got a process that is leading to very high payment rates, making that process work better can be a double-edged sword. Because right, if you make it much more accessible and much lower fees, you may see a lot more providers deciding, well, maybe I really can intensively use arbitration and then use that to leverage a higher rate. So you can end up a little bit sort of through the looking glass here, where sort of good government can have sort of bad outcomes.
No sunshine here is the answer.
We have some more questions, I think, over here.
So a different question on that line, Matt, is game theory would seem to indicate with baseball style arbitration that at some point in time we'd reach an equilibrium out of network cost in the process, which would then make it not worth paying the price of arbitration. Has anybody modeled how long this has to go on before okay.
Yeah, you'll go back if you look through the sort of pieces that I and Lauren Adler and Bennett Polito have written on this. It's eventually there's a learning process that should unfold where shouldn't go to arbitration because it's better to just reach the agreement that's going to come out of arbitration outside of arbitration and avoid the fees. But that's eventually is very much what we have to say. I think there's not a whole lot of evidence on how quickly this process is emerged, and clearly that's not where we're headed. And I will say one thing that makes it hard is another thing that there was a GAO report talking a little bit about just a lot of variation in how arbitrators make decisions with seemingly similar facts. And that sort of variability actually makes that learning process much harder, particularly to the extent that providers or insurers are primarily learning from the cases they've seen. If there's a lot of variability and you have a small sample size and it's then hard to extrapolate, it can be very hard to sort of get to the point where the people on both sides of the table have the same view of what's going to happen if they go to arbitration, and so strike that deal outside arbitration.
We have another question over here. Oh, sorry. There you go.
Thank you all for your time today. Boston Scanning Center. How much of this do we think is due to hospital consolidation in terms of them having more leverage, more resources to actually go to arbitration compared to the providers?
I'll weigh in on that. I think when we look at kind of where the arbitration is coming from, it's less from hospital systems themselves, although there is a whole new conversation we should have about hospital consolidation that's impact on process, which is gigantic. In this case, I think you're talking about typically sort of private equity owned large provider practices in a particular sort of set of areas. Again, emergency physicians. I think it's not unrelated, but I don't think it's directly a product of hospital consolidation. I do think it's interesting, and this is where a lot more data will be fascinating to see, is why is it that I understand why private equity backed companies do this, throw a load of money on it. But why is it that sort of smaller practices, 80% of the time, they're not going to arbitration. They're just able to accept it. Maybe it's because they're reasonable people. Maybe it's because they haven't picked up on the game yet. But it is interesting that it may very well be that it's these large practices that say, I have the capacity and willingness to go to arbitration. It takes time, it takes effort. They've got to put together a whole bunch of stuff. And if I'm a small, single, small practice, I'm like, I just don't have the time for that. I'll just accept it. Right? That I think is going to be an interesting question.
We have some more audience questions. Got somebody here.
Thank you. Am I on? Okay, great. Patricia Kalmar with US PIRG. So I think that there's two pieces of information that we actually don't know and still need to know to be able to really evaluate the IDR process, although I agree with the panel that things are not looking great. First of all, there are a lot of headlines that there are so many IDR disputes, but I would argue, first of all, it's pretty early somewhat in the process, especially considering all the different court decisions that have changed the IDR process over the last few months. So um, I would love to know what's the denominator, right? Like how many out-of-network bills are there that could have been brought to IDR that haven't been? And then I'm very grateful for all the new data that just came out about the IDR decisions. But I think the other question is, I believe that the arbitrators are supposed to tell you why they decided what they decided and how they came to a decision. There's a template that they can fill out, and it's my understanding that they are. So as the court decision came down that said the QPA wasn't the primary factor, and you can look at all the other things. I mean, we had always been raising as consumer advocacy organization, like you shouldn't get to look at how sick the patient is and argue that in IDR. I mean, you get to do that with your codes. You get to already bump up your codes and bill more. So it's a double counting when you go to IDR and you say, oh gosh, you know, the patient was super sick and we need more. Well, their billing codes would have reflected that as well, and they'd already been paid for that. So I wonder if some of these, you know, inflated IDR payments are actually reflective of some double counting that the courts have allowed to happen.
Anybody want to take that?
So on to just like what share of cases. I mean, the data I've seen suggests that it's maybe sort of 5 to 10% of the sort of in-universe out-of-network claims that are ending up in IDR at this point.
That's growing.
Growing, but that's sort of it's, you know, that's where we are. I do think the issue is here, you know, as you know, this is a situation where sort of the tail can wag the dog, right? Like as we were talking about, it only takes a sort of, if people prove that you can do really well and you go to IDR, it doesn't matter that there aren't any cases there, that still can have all the downstream effects, both for the rest of the outer network awards and then for in-network stream. In terms of why awards are ending up where they are, I think that's a really interesting question, and I don't feel like I have a great picture of that. I mean, one hypothesis that we've been kicking around is that, you know, it may be that some of the groups that are using IDR particularly intensively right now are groups that had higher contracted rates before the law, and since higher contracted rates is one of the other factors that arbitrators are supposed to consider, maybe that's actually, the arbitrators are giving that a lot of weight. I frankly think they shouldn't be, since I think these are probably particularly the groups that were sort of using the threat of surprise billing to leverage a very high contracted rate before. But it's possible there's some of that happening. But I completely agree. I think like it will be useful to get a look inside the black box of like how arbitrators are making decisions, and maybe there will be things that come out of that you know, dispel some of the pessimism about there's, you know, not real scope to make this process work better without this.
That was, yeah, I'm sorry, we're getting close to time, unfortunately, but why don't we finish up with this question and then maybe hear a little bit afterwards.
Cheryl Fitzpatrick for Families USA. Can you talk a bit about what's knowable about what private equity firms are keeping versus what the provider is getting, and also about this statement?
So right, in a decision, sort of private equity backed decisions happen. I mean, there's ultimately a question about like what are the salaries these firms are paying to the extent that they're on a salary model. I have not looked carefully at that question, and you know that's obviously in terms of the state variation. I don't have, I think, much to add over some of what Jack was saying. It is very geographically concentrated. Probably maybe that's linked to some extent on the sort of geographic footprint of where some of these provider groups are, but I think this is very much just more to be done on that.
And Katie, you had something.
Yeah, I need to make one correction. I need to go back in time and edit myself about the patient protections that we're talking about here. I have conflated the advanced explanation of benefits, which is available to insured patients and is not in effect with the good faith estimate that is for patients who are self-pay. So I want to make sure that's really clear. The self-pay good faith estimate is not a patient protection, whereas those that are included in the AEOB do have some limited scope for protections for patients. That process is cumbersome and not yet in effect because it is it is difficult. So I want to just make sure that I put a finer point on that and go back in time, with my magic eraser, and figure that all out for you. But thank you, Julie, for letting me make that
No
amendment.
problem. And thank you all panel for this great discussion. I really appreciate it and great questions from the audience. Unfortunately, we are out of time and we're gonna have to wrap it up right now.
Can we, let's thank the panel. What a great discussion. Thank you so much. And thanks for all of you being here. Great questions, great audience. We're gonna have another one of these event series in later May, and we'll make sure that we keep you posted on that. It'll be under the same theme, not necessarily the NSA. But I also just a couple of other issues. We're gonna be having this video of the discussion today. It'll be posted and available. Please do share it with all your colleagues that were not able to attend. And there's a number of research papers that we've been engaged in. They're in your brochure. One is the RWJ study that Jack talked about, and then the more recently published Commonwealth study that talked about the initial IDR data. We're also taking a deep dive into the data, so we'll probably have something coming out in the coming weeks, and I think Brookings is probably doing the same. So thank you again for being here. Thanks for being a great audience, and hopefully we'll see you in May. Thank you.